Most crypto traders watch the price, while the smart ones watch the momentum. The MACD, or Moving Average Convergence Divergence, is built to track exactly that. Is the trend accelerating, slamming on the brakes, or about to pull a U-turn? This is BingX Crypto Trading 101, and in this episode we break down how to use the MACD indicator to read momentum before the move happens, so you can time smarter entries and exits. Let's get into it. What is the MACD indicator? The MACD is one of the most widely used indicators in crypto trading today. By comparing short-term and long-term price trends, it shows when prices might start rising or falling, making it easier to decide when to buy or sell. To understand the MACD, you need to know its three main parts: the MACD line, the signal line, and the histogram. First is the MACD line. This line measures the difference between a short-term trend and a longer-term trend. When the MACD line moves upwards, it means short-term momentum is getting stronger, and when it moves downwards, momentum is weakening. Next is the signal line. It's a slower, smoother line based on the MACD line itself. It helps you spot crossovers more clearly, and that's where trading signals start to appear. When the MACD line crosses above the signal line, momentum may shift upward. When it crosses below, momentum may fade. Finally, the histogram. This shows the distance between the MACD line and the signal line using vertical bars. When the bars grow taller, momentum is increasing. When they shrink, momentum is slowing. Bars above the zero line are bullish, while bars below are bearish. Why crypto traders use the MACD? So why do crypto traders love the MACD? Because it does the work of multiple indicators in one. It tells you trend direction, momentum strength, and gives you clear bearish and bullish signals. Unlike a single moving average, it combines both trend and momentum together. That's why it's one of the first indicators serious traders learn. How to read the MACD on a crypto chart. Once you know what to look for, reading the MACD is surprisingly straightforward. The MACD appears in a separate panel below the price chart. You'll see a blue MACD line, an orange signal line, and green or red histogram bars. When the blue line crosses above the orange and the histogram turns green and expands, bullish momentum is building. When the blue crosses below and red bars expand downwards, bearish pressure is increasing. Simple as that. 4 best MACD strategies for beginners. So, how do you trade using the MACD? Let's walk through 4 practical strategies. Strategy number 1, crossover signal. The crossover signal is the most popular MACD strategy, and it's exactly what it sounds like. When the MACD line and signal line cross, it's a sign that momentum is shifting and price may be about to turn. In this BTC/USDT chart, we see a bearish crossover between $102,000 and $106,000. The MACD line crosses below the signal line, bars start contracting, and a downturn follows. Then, a bullish crossover near $78,000. The MACD line crosses back above the signal line, green bars start expanding, and Bitcoin rallies all the way to $110,000. Strategy number 2, zero line confirmation. The zero line, also known as the baseline, is the neutral point of the MACD. When the MACD line crosses the zero line, it signals a shift in market trend. Above zero is bullish and below zero is bearish. We can see this clearly here. At around $96,000, after the MACD line crosses below zero, BTC eventually falls to $76,000. Then, when the MACD line crosses back above zero, it leads to a breakout where BTC rises to above $104,000. Think of the zero line as your confirmation that the bigger trend has shifted. Strategy number 3, histogram momentum analysis. The histogram gives you a visual read on how strong momentum actually is. When the green bar starts shrinking or red bars appear, bullish momentum is weakening. As the histogram contracts, BTC continues to fall. Watch what happens on the way up. As BTC surges from $83,000 to $109,000, green bars expand above zero. The histogram is telling you bullish momentum is building and the move is real. Strategy number 4, MACD divergence. Divergence is one of the most powerful MACD signals, and it happens when the price and the MACD move in opposite directions. Here, BTC hits a high near $110,000, but notice how the MACD shows lower highs? That's bearish divergence, and a reversal follows. Bullish divergence is the opposite. BTC forms lower lows around $76,000 while the MACD forms higher lows. What happens next? A strong rally above $109,000. Divergence doesn't guarantee a reversal, but it's a signal worth watching. Combining MACD with other indicators. The MACD is powerful on its own, but it gets even better when combined with other indicators. Here's an example. Near $84,000, BTC shows a bullish MACD crossover. With RSI climbing above 50, that's already two signals aligned. Then, price breaks above a descending trend line, and that's the confirmation. BTC rallies towards $109,000. No single indicator tells the whole story, but when the MACD, RSI, and price structure all agree, that's when you act with confidence. Is the MACD always accurate? Now, let's talk about limitations, because no indicator is perfect. The MACD struggles in choppy sideways markets. When price is stuck in a tight range, you can get frequent crossovers with no real trend behind them. Traders call these whipsaws, and they can trigger bad entries if not careful. The fix? Zoom out. Check the 4-hour or daily chart before acting on a 1-hour MACD signal. Add a moving average as a trend filter, and in low volatility periods, treat MACD signals as a heads up, not a green light. The MACD blends trend and momentum into one clear indicator. But here's the thing, no indicator works alone. Are you combining the MACD with RSI, trend lines, and volume? Because that's where the edge is. Let us know in the comments what indicator you want us to break down next. Until then, trade smart, stay disciplined, and we'll see you in the next one.